Hey San Diego, welcome back to the Apartment Geek Weekly. I'm your host, Chris Robinson. I feel like a tennis pro today, or a professional golfer with this new hat that I got. A little shout out to Aaron Chang, the world-renowned photographer. He does a lot of ocean and nature stuff, really good guy. He's in my Sage executive group when I saw him yesterday, so I'm rocking his hat. Today, I'm inspired to talk a few minutes and kind of do, I'm gonna have a little fun with this. It's gonna be like, a 3-minute crash course for, I wanna say, newer investors, people that don't own huge portfolios of apartments yet, but wanna get to a point where they're creating wealth and they're creating cash flow. So the audience of this may be a little bit sophisticated for this, frankly. I hope you still listen. I'm gonna make this short. But I think this could be good for people that you may know, whether it's your kids or it's friends that have children that want to get into real estate who are in their 20s and 30s or whatever age, or people that are a little bit up in their years and are still wanting to kind of grow. And this is going to be like a reminder of the fundamentals and what to focus on when you're looking at putting your hard-earned money into real estate investments. And this was inspired by, I was up in Leucadia a couple of weeks ago with a friend. We had coffee, then we went to check the surf, a place called Beacons. And there was this really sweet younger woman, residential broker. If she's watching this, I'm gonna throw her under the bus. Not personally, she was really cool. And I loved how she had this little desk out, and she was giving free coffee and pastries away to random people that were checking the surf in this parking lot. And I thought it was a cool way to kind of think outside the box for developing business. That's a side note. So I started talking with her, and I realized how much money a lot of younger people are making right now, even in this pandemic, in real estate finance. I've got buddies making $2-3 million a year this year. With all the loan refinances and purchases. And then a lot of real estate brokers who are in the business and are having record-breaking years because they're so busy with all of these residential transactions because the interest rates are in the 2% or mid-2s, whatever it may be. And this woman started talking about how she wanted to go buy like townhomes or condos in, I think it was North Carolina, because she thought that the area was going to appreciate because of development or gentrification or whatever it may be. But the drive for her to put her money into these properties was because of this perceived appreciation or this hope that that area was going to get better. And in a loving way, I said, I think it's important. I think it's more important to focus on what the numbers look like, the cash flow looks like going into the property day one, or maybe now month 6 or month 12, because now we've got rent control, the runway's a little bit longer. My point with her was to only buy real estate in areas that you generally believe in, that you think are desirable to live in, but only buy apartments, specifically housing, rental property, in areas where you're gonna make cash flow in the first year, period. So you buy off return, you buy for cash flow, not for this perceived appreciation. Appreciation is going to happen because that's what happens when you buy real estate. You own the land. We're not making any more land, so the land naturally is going to go up in value, especially if you're in the West Coast or you're in a market maybe like Austin, Texas. You're in a very infill, hip place where people, frankly, just want to live. San Diego's not going out of style. Austin's not going out of style. There's a lot of good markets throughout the country. So if you're in those areas, you just want to basically focus on the fundamental indicators and only purchase if you are going to make money, make cash flow. So we're going to get there in a second. And I remember mentioning to her, I said, I'd rather own the dumpiest property in San Ysidro next to the border here than the nicest property in North Carolina. So because I know this one's gonna make money, and I know that anything in San Diego that you purchase over time will appreciate. That's the way it happens. You can go back 100 years and that's what happens. So what I want to talk about today, and there's so much noise out there about, I'm going to buy this and then I'm going to rent it out. I'm going to buy this condo in Encinitas at the beach and then I'm going to rent it out. I'm going, you have no idea what you're talking about, because the numbers are going to be completely wacko, for lack of better words. And the, you know, they want to live there for a little bit and then they want to rent it out. I'm going, I don't know what you're thinking. If you want to live somewhere, my 2 cents is you buy or you rent a place only because you love it and you want to live there for your primary home. And if it's not that, then you put your money into property that's going to basically give you cash flow. So what I want to talk, and this doesn't apply to the Jeff Bezos or Mark Zuckerberg or the tech guy who just sold his company for $400 million and he wants to diversify and put his money into coastal apartments in La Jolla. That's a different deal, and that's kind of wealth preservation and maybe diversification for extremely wealthy people. This message, and whoever may get this sent to them, is this message is for people who are young, who are still wanting to grow and get in the game, or if they're in the game, they want to continue growing their portfolio. So it applies to kind of the active, or I should say proactive investor who's growing. Gross rent multiplier, that's all you need to know. GRM, we call it in the business. It's something that I use on a daily basis with all my guys. Gross rent multiplier, it's like going to buy a car, and gross rent, GRM is like the engine, and the engine's going to move the car. And it's the most important indicator, financial indicator. It's how you assess how attractive the cash flow is going to be on a property. And it's like the engine. And then everything out on the outside is stuff we can kind of nitpick a little bit more, and we like this color or that color or whatever. But we really want to focus, you really want to size something up by the gross rent multiplier. And the GRM, I don't want to give a full real estate lesson here, but I hope if you don't know what the GRM is, you Google it or you maybe watch a YouTube video on it, specifically what GRM is. But it's the ratio of gross annual income to the price that you're paying for the piece of property. So the rent rule, say it's a 10-unit property, 10 one-bedrooms are renting for $1,000 a month. That's 10 grand a month. You can't fudge that. You have a rent roll with Susie in unit A and Joe in unit B. They're each paying $1,000. There's no fudging there or estimating it, kind of like what you do with expenses, which gets you to a cap rate. And that's why everybody's so into these cap rates. And cap rates there's a lot of wiggle room there. And I think people get themselves in a little bit of trouble with that. So if you go to a GRM, there's no wiggle room. You have a rent roll of 10 units, 10 grand a month or whatever it is. Over 12 months, that's $120,000 per year. That's the gross annual rental income. So the GRM equals the price that you're paying for the property over the gross annual rents. It's very basic. The lower the number, the more attractive it is from a buyer's perspective, the more income is coming in relation to the price of the real estate. And the higher it is more aggressively priced. It's going to take more work to kind of create cash flow there. And the margins are going to be a lot thinner. So if you go buy in La Jolla or Del Mar, your gross rent multipliers are 17, 18, 19, 20. If you go buy I'd say the C- area of San Diego, you're maybe at 12, 11 and a half or 12, somewhere in there. So the lower is better for a buyer perspective. Another way to think of GRM is the number of years it would take to pay off the price that the whole property price with the gross annual rents. Lower the number, fewer years to pay off the price of the real estate. Higher the GRM, the more time it's going to take. So that's kind of an interesting way that's kind of a cool perspective that people can kind of get their arms around understanding what the GRM is. So anybody who's looking at buying a condo or buying something, figure out what the rent is per year that's coming in, whether it's a condo, which I wouldn't buy anyways, or a 20 unit or a 100 unit, whatever that may be, and figure out what it is. If you're younger, or I should say growing your portfolio, and if you're buying anything above a 14, 13 and a half, 14 GRM, it's going to be pretty tough to make money on that deal unless you're coming with a huge down payment of 40, 50%. You're just going to be, the margins are going to be very slim. You want your GRM to be under 13, or if it's a little bit higher and the rents are real low, then there's an opportunity to raise those rents. But you want to get your GRM, say 1 year out, I would say under 13. You know, if it's 10, 11, 10 would be very attractive. If it's around 11, 12, 13, that starts to make sense. And then from there, you start looking at what the expenses are, and you just make sure that the expenses are kind of reasonable. And once we look at the expenses and we budget in repairs and maintenance and reserves and vacancy and all that jazz, that's where we get the cap rate. And everybody talks about the cap rate. I'm going to buy this 6% cap rate at a GRM of 15, and they're just completely whacked out ratios. And the problem there is the cap rate, the expenses were not accurately portrayed in the underwriting or the financial breakdown of the expenses. So I hope people that see this, that have, anybody that they know in their circle, forward this video to them, have them look at GRM, and if they really are serious about buying real estate for investment, get them to know the GRM like the back of their hand. And you can you can look at models and you can practice kind of the formula. It's very basic, and I don't hear it enough. And I'm seeing a lot of people making a bunch of money in 2020 and probably 2021 that are foolishly looking at deals or putting their money into deals where I think they're going to have a rude awakening unless they really understand gross rent multiplier and the fundamentals of why you buy real estate, which is for return, not some kind of like speculative appreciation. That's icing on the cake when the property value goes up. So another thing is, don't bet on short-term income. Like, I'm going to buy this deal in Ocean Beach by the sand, and I'm going to do short-term income and do this and that. That's fine. I know there's a lot of people that crush it out there doing like VRBO and I get that, but we've had videos about that when that's a little bit more difficult to scale. So if you do that, that's okay. But I think the key to real long-term success in rental property is long-term rentals that are month to month, or people that are on 1-year leases. And that's how you're going to be able to create some predictability and some certainty. And the number one thing we've talked about with a lot of wealthy people that I know or we communicate with is they want predictable cash flow every month. They don't want 20 grand a month this year or this month because it's summer and everybody's from Arizona is renting this condo, and then it goes down to 4,000 because nobody's here or COVID-19 is here or whatever the heck the situation is. Let's focus on essential month-to-month stuff or year-long leases, and then having people understand what are the real numbers going into this deal, and get people to really understand the GRM. That's really what I want to do here. And hopefully this gets to people, again, who are kind of maybe a little bit novice. This group is fairly sophisticated or very sophisticated in multifamily investing. So all the best. The Apartment Geek is out, and maybe I'll go play some tennis today and practice my game. We'll see. Thanks for tuning in.